Hey, what's up, my friend? So let me ask you, do you feel this way after trading for a while? Perhaps you've tried technical analysis, fundamentals, price action, volume, but still, you're not seeing the results that you want. Or how about this? You've blown up multiple trading accounts and you have no idea why it happens or how to avoid it. Or maybe you've heard that there are many different types of strategies out there, but you do not know what works and what doesn't. Because here's the thing, if every strategy works, then clearly there will be a lot more profitable traders out there. Agree? And of course, you know that's not the case. Now maybe you've traded a strategy for a while and maybe made money with it at the start, but eventually you give back all your profits and more. Why is that? Or how about this? You're trying to find the best indicator, the best settings, the best strategy, but somehow something better always comes along. Why? Now, if you can relate to what I've just shared, then you are not alone. And if you are looking for answers, then the answer is here. It lies in this trading pyramid over here. You've probably never seen this before, but don't worry, right? What I want to share with you is that a mistake many traders make is that they start at the top of this pyramid. And it's like building a house, but you're starting with the roof first. It's not going to work, right? So this is why, if you want to be a profitable trader, we need to start from the ground up with the trading success formula, and then we slowly, progressively move up the pyramid. And that's where we're going to start in today's video. And I promise you, if you understand what I'm about to share with you today, then you have what it takes, or you'll know what it takes to become a consistently profitable trader. And if you apply what I teach you, there's no reason why you can't find trading success. Sounds good? Then let's get started. Now, let's have a look at the first part of the trading success formula. The first part is this, an edge. You must have an edge in the markets. In other words, your trading system must be something that you can do repeatedly that yields a positive outcome in the long run. You might be wondering, but Rayner, how do I know if my trading system, my strategy has an edge in the markets? Great question. So this is where this formula comes into play. Because if you plug in the numbers, okay, if you've done your back testing, your forward testing, you will have these numbers, right? And if this number is positive, it means that you have an edge in the markets. So E stands for expectancy, or if you want to call it edge, I leave it to you. So E is equals to your winning rate, your winning percentage multiplied by your average gain, minus your losing rate, your losing percentage multiplied by your average loss. And if this sounds confusing, don't worry, I'll give you a few examples so you can see how simple this is. I think a 10 or 12-year-old will catch this pretty quickly. So let's have a look at this. Imagine this, you have a trading system that has a 70% winning rate. Average gain is $80 per trade on average, and your losing rate is 30%, average loss is $100 per trade. So you plug in the numbers. This, remember over here, is your winning rate, 0.7 from this 70%, multiplied by 80, which is your average gain over here, minus 0.3, which is your losing rate, multiplied by your average loss, which is $100, and you get $26. So what does this $26 mean? This means that on average, when you take a trade, you can expect to make about $26 per trade. So if you have done 100 trades, that's about a profit of around $2,600 after 100 trades. So this example, clearly you have a positive edge. If your trading system has this matrix, you have an edge in the markets. Now, on the other hand, let's look at a negative edge. So in this case, again, winning rate 70%. Let's say this time around, your average gain is $10 per trade on average. Losing rate is 30% and your average loss is $100. If you plug in the numbers now, what's going to happen is that you are going to get minus 23. This means on average, you can expect to lose around $23 per trade. So if you take 100 trades, you will be down about $2,300, right? Thereabout after 100 trades. Now that you've seen the importance of an edge, why your trading system must have an edge, that's not all, because you also need the second part of the formula, which is risk management. Risk management is all about protecting your downside no matter what happens. Even if you have 10, 20 losing trades in a row, guess what? If you have risk management, your account should not blow up. Your account should still be able to recover from that drawdown. That's the purpose of risk management. Because without sound risk management, even a profitable trading system will fail. Even if you have an edge, you will still blow up. Let me give you an example how this works. So if you look at this, imagine that there are two traders, John and Sally. Okay, and let's say John and Sally, they both have a $10,000 trading account. They have a 50% winning rate and they have an average of a 1 to 3 risk reward ratio. So you can imagine this, if you have a 50% winning rate with an average of a 1 to 3 risk reward ratio, you're going to make money in the long run. You're going to make quite a bit of money in the long run because you have an edge. You have a positive expectancy. But that may not be the case because it also depends on how much you're risking per trade. So in this case, let's say John risks $5,000 per trade and Sally risks $100 per trade. What would be the outcome for both traders? Let me walk you through. So for John, it's quite straightforward. John, he risks $5,000 per trade. And the outcome of the next 10 trades is, lose, 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 lose. He won't even see the wins. Why is that? Because first trade, John loses negative $5,000. Second trade, negative $5,000. Before he can even see the third trade, he's wiped out. John is kaboom, gone. His account is gone, so wiped out. What about Sally? So for Sally, I need to do a little bit more work because she's a conservative trader. So for Sally, 1, 2, 3, 4, 5. Her first 5 trades are losses. So when she loses, she will lose about $100 per trade because she risks 100 per trade. So I'll just put here minus 100 multiplied by 5 times. Okay. In the past, I used to draw it minus 100 5 times and it gets a bit tiring. So her total loss for the first 5 trades, Sally is down negative $500 from here. Okay. But then, because she has risk management, she managed to leave to fight another day. She managed to leave to see better days ahead. And her remaining next 5 trades are all winners. And if you look at it, right, she has an average of a 1 to 3 risk reward ratio. This means on average, her winners is 3 times the size of her losses. So on average, her winners is $300, the average size. And because she had 5 winning trades, 1, 2, 3, 4, 5 over here, you multiply by 5, her gains in this case is $1,500. But of course, that's not the net profit because you also need to factor in the losses she accumulated earlier. So her net profit is $1,000 after 10 trades. And starting with a $10,000 account, that's a gain of about 10% for Sally. So you can see, right, 2 traders, John and Sally, trading the same system with the same winning rate, the same average risk to reward. One of them blew up, which is John, and the other one, Sally, made a 10% gain on the account. So by now, hopefully you can see the importance of risk management. So we have covered a couple of things over here. You need an edge, you need risk management, right? These 2 things are critical for the trading success formula. And of course, that's not it also because you also need discipline, right? You must have discipline to follow the rules of your trading system, no matter what happens. Right? Whether it's raining, whether it's snowing, whether you feel like it, whether it's you must be disciplined. Because the fact is this, right? When you have consistent actions, you're going to get consistent results. And when your actions are inconsistent, guess what? You're going to get inconsistent results. So that's a given. So now, I'll walk you through these few scenarios, which is pretty common, right, in the world of trading. If you're a trader, if you have an edge and risk management but no discipline, what's going to happen to you? I can tell you what's going to happen. What's going to happen is that you will get inconsistent results. Yes, you have a trading system that works. Yes, you have sound risk management, but because of your lack of discipline, sometimes you feel like putting on trades, you put on. After 6, 7, 8 losers in a row, when there's a valid trading setup that comes, you hesitate to take the trade because the fear of losses is crippling you and you skip the trade. And what happens? When you skip that trade is about to be a monster winner that will recoup back all your losses, but you missed it because of your fear, because of the lack of discipline. And that's what's going to happen to you, right? If you are someone who has an edge and risk management but lack the discipline, right? You are going to get inconsistent results. Now, what if you're a trader who has risk management and you got discipline, but you have no edge? What's going to happen? In this case, you are going to suffer what I call death by 1,000 cards. It's like going down to a casino, right? You can have proper risk management. You bring $10,000. Each time you bet, you only bet $20, $30, whatever. And if the discipline, right, you follow the rules of your bet consistently. But because the house has an edge over you, you're going to lose in the long run. You may not lose within a few hours. Maybe you take you a few days to lose all your money or a few weeks. But eventually in the long run, because you don't have an edge, you will lose to the casino. That's what we call death by 1,000 cards. And finally, the last one. What if you have edge? You have an edge and risk and discipline, but you don't have risk management. What's going to happen? Well, what's going to happen is that you're going to be just like John, right? You're going to blow up eventually. You can make, You can make maybe some money at the start, maybe due to luck, but eventually due to the lack of risk management, you're going to go kaboom, blow up your account. So to sum up, this is the trading success formula. You must have an edge plus risk management plus discipline, and only then can you be consistently profitable in the long run. And this formula holds true, right? Whether you're a day trader, options trader, price action trader, systems trader, whatever trader, this formula holds true. So now, I've shared with you the trading success formula, and some of you might be thinking, so Rayner, how do I then go about finding an edge in the markets? Great question. And this is where we want to talk about, or rather I want to talk about the second part of this pyramid, which is your strategies, because there are different types of strategies out there that you can use to extract an edge in the markets. So a quick overview, these are a few of the strategies that you can consider. Personally, I trade all of these different type of trading strategies. This is not a comprehensive list. There are probably more that I've not put on this slides, like for example statistical arbitrage, calendar spreads and whatnot, but this tree is more than enough for you to get very far ahead in your trading career. And of course, if you want to take it a step further, go and explore, right? Even the stuff that I have not managed to cover in this slide. So there are different types of strategies: mean reversion, trend following, and momentum. And I want to share a little bit more about such strategies because they are very applicable to retail traders. If you're someone like me who trades from your home, okay, you don't have fast connection like high frequency traders and whatnot. These are strategies that you can actually employ and profit for the long run. So mean reversion trading, let's talk about this. So mean reversion trading, the idea behind this type of strategies is that you're looking for stocks or assets, right, to deviate away from their average price. Just imagine like a rubber band. You stretch the rubber band, right? It's extremely stretched. And when you let go of the rubber band, what happens? The rubber band, snaps back. So same thing for mean reversion trading. We're identifying asset prices that are overstretched away from their mean, away from their average. And then we want to enter the trade in anticipation for this snapback. So an example could be a stock is in an uptrend, okay? And then it makes a deep pullback, oversold over here at this point. A mean reversion trader can look at this and say, this stock, has deviated quite a bit from its average price. There's a high probability it's going to snap back, so let me buy. Okay, a mean reversion trader would buy. And then when the stock makes a bounce up higher, they would sell. For mean reversion trading, they are looking to capture small profits, not to ride the trend. Right trend is trend following. So mean reversion traders, sometimes they're also known as swing traders. They're just looking to capture that one small bite of the move, one small piece of the move. And generally for mean reversion traders, they have a high winning rate, right? 60 plus, sometimes even 70% winning rate. However, their average loss is greater than their average profit. So for example, if their average loss is $100 on average, their average profit is possibly, 70, 80 or 80 plus dollars. And later on in this training, I will share with you a mean reversion trading system that works. I'll give you the exact trading rules, when to buy, when to sell, the historical backtest data results as well. So it's something that you can actually employ in your own trading if you wish to. So that will come later part of the trading. But for now, let's talk about trend following. So you've learned about mean reversion trading, and trend following is a different type of approach. This is where you're trading in the direction of the trend and riding the trend till it ends. For a trend follower, your winning rate is much lower, 30 plus to 40 plus percent, and your average profit is greater than your average loss, usually at least 2 times your average loss. So let's say your average loss is $100. For a trend follower, your average profit is usually $200 or more, right? A few times bigger than your average loss. And a typical trend following setup, right, looks something like this. Let's say stock or whatever asset. Oh, just one thing to add. Trend following, I would say, originated from the futures market. Think of the turtle traders, the 1980s, 1970s. These are where this group of traders, or this is where trend following was popularized, where they trade a basket of different futures market, corn, wheat, gold, indices, bonds, etc., and apply a trend following approach to them. So generally, the idea is they're looking for market to break out, right? Break out, they buy, and then they're looking to ride the trend till it ends. So in this case, they will employ a trailing stop loss and then only sell when the market hits their trailing stop loss. So thereby, for this type of strategy, they are looking to capture the meat of the move, trying to capture or to ride the trend till it ends. So this is a trend following approach. And finally, the last one is what I call momentum. Momentum approach is very popular with stock traders, where they identify stocks that have exhibited strong signs of momentum and look to buy and to sell when momentum fades. So I'll give you an example later on, but generally their winning rate can be anywhere between 30 to 50+%. Their average profit is greater than their average loss. So a typical momentum trading setup could be they look for a stock that's in the consolidation for a while, they look for a breakout, and then let it consolidate, forming something like a flag pattern. Then some of them could look to buy within this flag pattern, right, in anticipation that when the market breaks out of the flag, they could capture a nice momentum move up higher. So this is what momentum trader does, right? Identifying momentum in stocks, getting in, right, in anticipation that the momentum will continue. And of course, if momentum starts to stall, to reverse, they would then get out of the trade. And by the way, if you want to learn more about trend following concepts, how to write trends in the market, you can go down to my website, tradingwithrayner.com, scroll down and grab a copy of this trading guide over here called the Essential Guide to Systems Trading. So in this guide, I will share with you a trend following system that you can use to profit in bull and bear markets. I'll also share with you how you can go about developing profitable trading systems that has a high chance of working even if you have no experience. So all this and more in this guide over here, it's free. I'll put the link somewhere below this video, or you can go down to my website directly, tradingwithrayner.com, and just grab a copy. Right, just click the orange button and I'll send it to your email for free. Now, we have talked about the different type of strategies like momentum, trend following, mean reversion. So now the question is this, right? How do we then take these strategies and turn it into something tradable, something concrete, right? Because you can't just say, oh, I'm a mean reversion trader. And the next question is, okay, so when do you buy? When do you sell? Then you're the mean reversion trader, you go, it depends. No, it can't work like that. So this is where the third section comes into play. Okay, trading rules. How do we use the strategies, the concepts of the different strategies I shared with you earlier, and to convert it into a fixed set of trading rules that tells you when exactly to buy or sell, or how much to buy or sell. Okay, so this is what we're going to talk about right now. So trading rules are pretty much rules based on your strategy, whether it's trend following, mean reversion, momentum, etc. Trading rules gives purpose to your tools and indicators. If you don't quite understand what this means, right, don't worry, I will cover that in details later on. And finally, trading rules allows you to have consistent actions. And when your actions are consistent, you're going to get consistent results. So what exactly should your trading rules entail? For me, it's very simple. Trading rules must answer these questions. So I'll walk you through this, right? Number one, for example, which markets are you trading? Is it the stock market, the commodity, the futures market? What are the markets that you're trading? What time frame are you trading? The 1 hour, the daily, the weekly? What's the risk management? How do you manage your risk? How do you know how much stock to buy? And then this one is important. What are the conditions of your trading setup? And how do you know what are the conditions of your trading setup? This will then ties back to the earlier question. What's your strategy? Because the condition for a trend following setup will be very different from a mean reversion trading setup. It's kind of like, finding a wife. What are the conditions that you have? The girl must have long hair, a short hair, armpit hair. Just kidding, right? But who knows, right? There are some guys who insist, right, that their wives must have armpit hair. I'm not here to judge. Next one. When do you enter a trade? Right? What is the entry trigger that gets you into a trade? And number 6, when to exit if you're wrong, right? Otherwise known as your stop loss. It's kind of like the girl that you're chasing, right? Going after the girl, courtship, but she's not responding. So when do you cut your loss? Well, dumb guys, right? They will average in and spend even more time and money on those girls. And that's how you blow up. Okay? And finally, number 7, when do you exit if you're right? AKA, right? What's your target profit? Alright, or if you got the girl, when is married, when you're going to pop the question, when you're going to pop the cherry. Yeah, so when is where to exit if you're right. So all this is what entails, right, a comprehensive trading rules, if you ask me. So now, we have spoken about trading rules. The question is then, how do you answer the question to these rules? And this is where we want to talk about the tools and indicators, which is the top of the pyramid. And if you ask me, I wouldn't say it's not important, but it is secondary, right, relative to the earlier components that we have spoken about. Because if you don't have these three components which I talked about earlier, your tools and indicators, they are pretty much useless. So now that you understand the trading success formula, the type of strategies you want to employ, and the importance of your trading rules, then yes, you can finally use the right tools and indicators to fit your rules based on your strategies. Does it make sense? Okay, now let's talk about tools and indicators. So some of the different types of tools and indicators that you might have probably come across could be things like trend lines, chart patterns, support and resistance, candlestick patterns. Indicators would be RSI, MACD, Fibonacci, pivot points, etc. It's not a comprehensive list, it's just to give you an idea of the different tools and indicators you could use or you might have come across in your trading journey. So question is this, what's the purpose of your tools and indicators? I've actually covered this earlier. The purpose of your tools and indicators is not to make your charts pretty to go for Miss Universe competition. Nobody cares how pretty your charts looks like. They only care whether you make money with it or not. So the purpose of your tools and indicators is to help you develop your trading rules, which is based on your strategy. Repeat after me. The purpose of your trading rules, the purpose of your tools and indicators is to help you develop a set of trading rules, which is based on your strategy. Yeah? Okay. And if you recall, your trading rules must answer these questions. I bold number 4, 5, 6, 7 because this is so important, and this is where your technical analysis, this is where your tools and indicators come into place. So now hopefully by now you can see how everything is coming together, right? You're not just blindly, randomly adding stuff to your charts because it looks good. No, not that way. You're actually, every tool, every indicator on your chart, they must have a purpose. And that purpose ties back to the trading rules that they're trying to serve. And that trading rules ties back to the strategy that you're trying to employ. And that strategy that you're trying to employ ties back to the trading success formula that I talked about earlier, the ERD, having an edge, sound risk management, and a discipline to follow your rules. All good so far? Right? Then smash the thumbs up button and subscribe to this video if, it's all making sense so far. Now, I know I've covered a lot of material and some of it might be things that you have not thought about before. So let me give you an example of how you can use the concepts that I've just shared with you earlier and develop it into a trading system that works. Okay, so let me give you an example of it, right, of a trading system that works as promised. So overview, right? So the strategy that we are going to talk about or I'm going to teach you is a mean reversion strategy. The trading rules, it's coming up, it's just in the next slide. And the tools and indicators that we are using is moving average, Bollinger Band, and the RSI. And you'll see why shortly. So to do a quick recap, right? A mean reversion strategy for this particular one, we are looking to identify stocks that are in an uptrend, to make a pullback when the stock is oversold, far from the average price from the mean, and then we're looking to buy. And when the stock makes a pop higher, a bounce higher, we're looking to sell, capturing that one swing in the market. So how can we then take this strategy and convert it into a set of fixed trading rules using tools and indicators that you're already familiar with? So let me show you how. So let's say we are going to trade the stock market, right? This will be stocks in the Russell 1000 index, basically the largest 1000 stocks in US. Time frame is daily. Risk management is 20% capital for each stock and a maximum of 5 position. So I'll just briefly explain what this means, the risk management. So let's say if you have $100,000 trading capital, you can buy a maximum of 5 positions, meaning 5 different stocks. So stock A, B, C, D, E, 5 stocks. And for each stock, how much of these stocks can you buy? You can put 20% of your capital for each stock, so $20,000 for each stock. Okay, so $20,000 multiplied by 5 will be $100,000, which is your trading capital. So how many stocks should you buy if there's a valid trading setup? Then in this case will be $20,000, which is 20% of your capital. So this is our risk management to it, and there is no leverage involved. Now, this is the trading rules, and I'm going to explain step by step how the indicators come into play, the purpose of it, and whatnot. So first one is the stock is above the 200-day moving average. So why are we adding 200-day moving average to the charts? Because it looks pretty? Because the institutional traders have it on their charts? No. The reason is simple. It's our criteria to define an uptrend. And when the stock price is above the 200-day moving average, we can conclude and say, hey, the stock price is in an uptrend. It's kind of like, you want to make love to your wife. You want to hint to her, you want to ask her the question when she's in a good mood. Agree? You don't want to do it when her face is black, sour, like this, right? You're probably going to get a slap or, be sleeping in the living room or something along those lines. So same thing for trading, stock trading. You want to buy stock that's in an uptrend, in a good mood. Yeah. So that's the reason why we have our moving average as part of our trading rules. Second one, the stock price closes below the lower Bollinger Band. So in this case, we're using Bollinger Band to help us define the pullback. So if you recall, the mean reversion strategy that we want to employ is to buy on the pullback, buy on the dip. And how do we define the pullback? There are many ways to go about doing it. You can use Bollinger Bands, you can use stochastic, RSI and whatnot, but for this example, I'm just using the Bollinger Band to help us define the pullback. And number 3, place a 3% buy limit order. So this is how we actually define when a stock is oversold. So if criteria 1 and 2 is met, and the third criteria is that on an intraday basis, the next day, the stock price drops another 3% on an intraday level, we will get filled on the trade because we have this 3% buy limit order that's being placed. So in other words, we're kind of like catching the falling knife, right? Traders or investors say, don't try to catch a falling knife. But guess what? We are doing the opposite right here, and I'll show you the results shortly. Okay? And number 4, if your order is filled, then you sell when the 2-day RSI crosses above 50 or after 10 trading days. So this is to help us define the exit signal, when to sell, when to sell our position. And we are using the 2-day, we are using RSI over here, again, not because we have to, but it's just for us to define, right, the bounce higher. So if you recall, as a mean reversion trader, we buy on a pullback, and then when it makes a bounce, we sell. So the 2-day RSI, when it crosses above 50, is when the stock price will make a bounce, and that's where we sell. And of course, we don't have to use RSI. We can say if the stock price makes a higher close over the last 2 or 3 days, we sell. That's fine as well. But I'm just using the RSI because I feel like it. Okay. And number 5, you're trading the Russell 1000. There's 1,000 stocks in the index, and there are possibly many trading opportunities. What if you have more than 5 trading setups to choose from? Which stocks do you want to favor? So this is where we want to rank our stocks, the strongest to the weakest. So we rank them using the rate of change, or we rank them using the increase in price over the last 150 days. So if there are too many stocks to choose from, we would favor stocks that have increased the most in price over the last 150 days. So stocks that have went up the most in price over the last 150 days, those will be our top few picks. And of course, assuming that they also follow the criteria of our trading system over here, right? The criteria 1 to 4. And last but not least, the Bollinger Band settings. I am not using the default one. I changed it, I tweaked it slightly. It's a 20-day moving average and 2.5 standard deviation. I believe the default settings is 2 standard deviation. Now, let me walk you through an example, a chart example, so you can see how these trading rules work. So, of course, this is a cherry pick chart. This is a replay mode on TradingView, and the indicators that we are using. Yep, first one is the 200-day moving average to help us define the trend. I'm going to change this to black because I like it that way. Okay, 200. And click OK. There you have it. Right. The stock price is above the 200-day moving average. First criteria is met. Second one is for the stock price to close below the lower Bollinger Band. So just look for BB, baby. There we have it. Bollinger Bands. Click on this. And it pops out over here. I'm going to change the settings to the one I shared with you earlier. And the only difference is the standard deviation, which is 2.5. Click OK. Kaboom. Okay, so if you look closely, you can see that right now the stock price has closed below the lower Bollinger Band. What's our third criteria? I think most of you can't recall, but it's to place a 3% buy limit order below the previous day closing price and to see if we get filled. And in this case, this candle, the closing price is, what is it? 113.7. Okay, 113.7. So how do you know what is the buy limit order to place? Very simple, just multiply by 0.97 since we are using a 3% buy limit order, and it gives us, let's see, right, the trusty calculator says 110.29. I just rounded up, 0.29. Okay, so we're going to place a buy limit order at 110.29. So in this case, I'm just going to put this line over here. Let's change it to 110.29. And I click OK. So what's going to happen is this, right? If the next day the stock price falls and touch this green line, we would have gotten filled on this trade. So next day, ka-ching, yep, you have gotten filled on this trade. As you know, it touched the green line. Now what about exit? Our exit is pretty straightforward. It's when the 2-day RSI crosses above 50 or after 10 trading days. And if you notice, right, 10 trading days is it's actually a time-based stop loss, because there are times when you buy the stock, even though it's oversold, there isn't any bounce. It just continues to dip lower and lower every single day. And of course, we don't want to hold it till zero. It seldom happens, but again, we don't want to hold it forever. We want to free up our capital for something more, for better trading opportunities. So we're going to hold a maximum of 10 trading days. So this is what it means. But most of the time, we are going to exit when the 2-day RSI crosses above 50. I think more than 50% of the time, you exit when the 2-day RSI crosses above 50. So if you get the indicator out, just type in RSI, Relative Strength Index, change the settings to 2-period RSI, just to 2. I don't need the MA. Click OK. Okay, so you can see that right now the RSI value is 7.78. So the moment it's above 50, that's a signal to get out of the trade. So in this case, let's see. Right now it's 5. Now it's above 50, 50.47. You can see over here at this close higher, 50.47. So this is where we need to get out of the trade. But the market is closed. So when do we exit? Well, we can exit on the next day open. So when you can see over here, the next day market open up at this price, move in our favor, and we would have exited this trade for a small profit. And that's an example of how this trading system works. And as you can see, right, we're not adding squiggly lines, RSI, moving average for fun. No, every indicator on the chart, they all have a purpose for the trading rules. And the trading rules is based on our strategy, which is a mean reversion strategy. I know I'm hammering this point over and over and over again because it's so important, and I feel that majority of traders just don't understand how it all ties together. Now, because this is an objective set of rules, otherwise known as systems trading, you can actually take these rules and backtest it and see how the performance, right? How is the performance over the last 20 plus years? So let's do just that. So you can see over here, over the last 25 years, this trading system has made a profit of about 2,834% over the last 25 years. So this equity curve doesn't give us too much detail, so let's dig a little bit deeper. I've exported the data from Army Broker into Excel, as you can see over here. Over the last 25 years, let's walk through the key matrix. Annual return is about 14.47% a year. We have taken about 1,634 trades over the last 25 years. Winning rate is 66%, which is again within the realm of it's pretty normal, right, for a mean reversion trading system. Our losing rate is about close to 34%. Our average profit percentage is 4.1%, and our average loss is about 4.78%. As you can see, right, our average loss is greater than our average profit. Maximum drawdown is 27% for this trading system. And over here, yeah, I just kind of like summarized the key findings earlier on Excel. Now, if you remember this formula, the expectancy formula, we can actually use those numbers that we have earlier and define what is the expectancy of this trading system. So quick recap, expectancy is your winning percentage multiplied by your average gain minus your losing percentage multiplied by your average loss. So in this case, what is our average gain and loss? So previously, we have defined it using percentages. So to find out what is the average gain or loss in dollar value, they just multiply it by the dollar value of the stock that you're buying. So assuming, let's say you buy $1,000 worth of stock each time, they just multiply accordingly. So in this case, your average gain is 4.1% multiplied by 1,000 is $41, and your average loss is 4.78. I rounded up, 4.8% multiplied by $1,000, which is negative $48. And then you just take those numbers and plug it into the formula. 0.66, which is your winning rate, multiplied by your average gain, which is $41, minus your losing rate, which is 34%, multiplied by $48, which is your average loss. And your expectancy is $10.74. So what this means is that on average, you make about $10.70 per trade. Now, you might be thinking, what? Rayner, I make $10.70 per trade on average. I'd rather work at McDonald's, man. Yo, what's up? I understand where you're coming from. So bear in mind, this is only one trade. And as a mean reversion trader, you will take hundreds of trades per year. And also depending how many mean reversion trading system you're trading. So let's say if you take, I don't know, 200 trades per year. If you take 200 trades per year, that is an average of $2,000 of profit a year. And let's say, if you can trade bigger size, let's say instead of risking $1,000 for each stock, you're risking $10,000 per stock, and you still take an average of 200 trades per year. You're looking at about $20,000 of profit on average a year. So the numbers do add up. Yeah. So as a quick recap, here's what we have covered today. I know it's a lot, so take your time to digest. First and foremost, we talk about the trading success formula. I explained that every single profitable trader must have this ingredient: an edge, sound risk management, plus the discipline to follow your rules for the long haul. Then how do you go about finding an edge in the markets? Well, for me personally, you can use, or rather I use things like, trend following, momentum, and mean reversion. And using these strategies, I have developed multiple trading systems. And I highly recommend you have a look at these strategies, because it's something that retail traders can employ on your own account. You don't need super fast speed to the exchange, you don't need to compete with high frequency traders and whatnot. So after knowing what strategies that you want to employ, then you need to develop a set of trading rules based on your strategies. And how you go about developing your trading rules, you can then use the relevant tools and indicators to fit your needs. So you don't have to randomly or blindly add lines on the charts just because it looks good. No, everything now has a purpose to meet your rules, and you know that your rules is based on your strategies. And the reason why you want to pick that strategies is because it could give you an edge in the markets that allows you to be a successful trader in the long run. So, and by the way, if you want to learn more about the different type of strategies, like today we talk about mean reversion, but if you want to learn about, let's say, trend following and whatnot, what you can do is also grab a copy of this book over here called Trading Systems That Work. So this is a book that I've written. It's a digital copy where you will get access to three proven trading systems that work, because I have rigorously tested it over the last 20 plus years. So this allows you, to profit in bull and bear markets, even during a recession. So the first one is a trend following system that trades the futures markets, basically covering the forex and commodities market. And since 2000, annual return is about 13-14%. Then we have a mean reversion trading system over here. This one is better than the one I just shared with you. This one average return of about 18% a year since 2000. And finally, we have a breakout trading system. This one is a blend between momentum and trend following, and it has an average return of about 17% a year on average. So I'm going to teach you these three trading systems. I'll give you the exact trading rules, like what I did earlier, the entries, the exits, the risk management, so on and so forth. And here's the best part, okay? I want this to be risk-free for you. So grab a copy of Trading Systems That Work, and if within 180 days you realize this is not for you, just shoot me an email, okay? Just drop me an email, and I'll happily refund you in full, no question asked, and you can even keep the book. How's that for being fair? Okay, so if that's something that you might be interested in, then just go down to this link, tradingsystemsbook.com, or I'll put the link somewhere below this video, and you can grab a copy. And of course, if you also want to grab a copy of the Essential Guide to Systems Trading, this one over here is free. Okay, this one is free, right? You can just go down to my website, tradingwithrayner.com, and grab this one, which is free. The Trading Systems book, which is this one isn't free, but it doesn't cost a lot of money. For just $17, you can get all the work done, all the backtesting done for you. So with that said, I wish you good luck and good trading. I will talk to you soon.